Okay. In today's session, we will try to think of about behavioral finance, and many of you are not feeling happy when we are spending much time regarding the new classical finance and the traditional finance concepts and the concepts on which classical finance builds on. Uh, so I already have emphasized that why it is essential to have a solid foundation regarding the traditional finance, the rational things, and the assumptions that will help you to improve your learning regarding the behavioral finance and the finance which deals with how people behave rather than how people should behave. So that is the big difference, how traditional finance is different from uh, behavioral finance. So let's move on. We will try to understand that how classical finance is different from behavioral finance and how you need to address these issues in portfolio construction. And we will try to know about the prospect theory. I don't know whether you have got some hints in your earlier modules regarding the prospect theory, from which we start the behavioral finance. And we also need to recognize that we exhibit some biases. So investors are not alien. Investors are among us. So if we become investors or if we become asset managers, as both are human being, so it is likely that we will exhibit some biases which are usually exhibited by the people in other decision-making process. Okay. Then we'll try to look at some processes, or we'll look at some recommendations that how can we overcome these biases so that our decision will not be kind of irrational and will not end up some poor outcome. Okay, so first of all, how behavioral finance is different from the traditional finance is that traditional finance is more and more based on some neoclassical theories and some economic theories, of uh, among which one of the very basic foundation is the utility theory. And people in academia have spent a significant amount of time and effort to understand about the utility, to understand how utility behave, because though utility is not the familiar concept with you in terms of the term you use in your regular life. In your regular life, you are very accustomed to use the term happiness. You always try to make decision which maximize your happiness. So people always look for the options. People always try to think a decision or uh, think in a way and decide in a way which maximizes their happiness and which reduces the probability that people will become unhappy. So behavioral finance is more dependent on how people behave and how people in aggregate, I mean the market behave, compared to the traditional finance, which is based on a good number of theories. I will try to uh, give some title of the theories which about which we have learned in the finance course or finance major. Okay. Then standard finance theories assumes that uh, people are kind of rational. Uh, uh, when we say that people are rational, you need to be very specific. What do we mean by the rational? Okay. We'll mention about it later. But for this point, we like to say that people use their all available information to make decisions, and people accommodate their decision with the new information, and people adjust their decision with the availability of new information. And when people make decisions in such a way, people collect information regarding which are essential to make a good decision. In that case, people make a rational decision. But matter is that in behavioral finance, it assumes that people are kind of normative. People are kind of normative rather than rational. People are more kind of normal. So uh, the concept is more kind of here. People are not normative. People are like more normal. Okay. We use the concept positive approach. Okay. In positive approach, we assume that people do not have all information available, or people do not have the required information, and people are likely to exhibit some of the cognitive bias, some emotional bias. So people do mistake. So uh, these are the things what happen to the normal people. Okay. So there are scientists, there are psychotherapists, then there are psychologists who spend their time to understand how people make decisions, what factors influence people's decision. So they try to use the three approaches to understand and to deal with the behavioral finance and deal with how people behave. Okay. So first of all, the normative analysis. Second one is descriptive analysis, and the perspective analysis. Okay. So normative analysis deals with the things how people should behave rationally. I mean, how people should behave by considering and by updating probabilities, by accommodating using the information available. But in descriptive analysis, our focus is not how people should behave. Rather, we try to think of how people actually behave in their decision making and in making investment these things. And prescriptive prescriptive analysis deals with as for example, a person is trying to exhibit some biases, kind of cognitive biases. We'll tell about what is about it later. So people are trying to exhibit some bias, uh, the bias is coming from information processing. People are not processing the information correctly, for example. So in that case, how can you modify the people behavior, or how can you suggest something to those people who are exhibiting this kind of bias, so that they will act rationally? That is the purpose of prescriptive, and that is the purpose of prescriptive analysis. Okay. So usually these three approaches are used to understand the decision-making process of individual. Okay, this is suggested by Raifa in 1997. So we already have got some ideas that how traditional finance is different from behavioral finance in our very lecture session 1. If you don't forget, so we mentioned that individuals are assumed to be rational in traditional finance, and they always try to maximize their utility, and they always spend time to understand how they can maximize their self-interest. And they always spend more time to about the self-interest other than thinking about the interest of their people, interest of their subordinates, interest of the general person. Rather, people are more concentrated to maximize their self-interest. Okay. Then in traditional finance, you can recall that in out of the 40 modules you have already taken, in most of the modules you have spent plenty of time to understand the proposition, which uh, tells you how arbitrage opportunities arise when these conditions are not met, and why arbitrage will lead to the market efficiency, and why arbitrage is attractive, and how the arbitrage will become available, and how arbitrage disappear. And you have learned, you have spent a good amount of time to understand the propositions made by Miller and Modigliani. And it is very likely that when you will uh, give an interview regarding the uh, with respect to some position in finance, some finance companies or investment companies, it is very likely that you will be asked that about the propositions. And currently, you are spending good amount of time, specifically in another class of portfolio management, to understand the application of Markowitz portfolio. So, which assumes that investors are rational. Investors just think of the risk and return, and they are the utility maximizers, and they consider only the risk and return to think of or to pick a particular asset to include in their portfolio. And they construct the efficient portfolios that do not hold any asset which is not in line with the efficient portfolio. And these things you are learning in the portfolio management course. And one of the pioneer in portfolio classical portfolio management is the Markowitz portfolio. And all other all other theories or all other strategies of portfolio are based on this. Okay, so these are kind of foundations of portfolio management. Then I do not know, have you heard about the this name or these leaders in the who have developed the CAPM uh, and spent their research to develop this CAPM model, which tells you that only you should expect the compensation for the systematic risk your asset is exhibiting, or your asset is related to, that how much systematic risk your asset has. Okay, so your compensation or your return will only depend on that systematic risk which is exhibited by the market beta. But the thing is that I do not know, have you learned about the Fama-French three factors model, then Carhart momentum factor, then Fama-French five factors? I believe that you have come to get some insights about this, though not in detail, but in brief. So all of these models are based on the classical assumptions and the traditional finance assumptions. And one model that is particular, you have already come to know about the derivatives, and options is one of the derivative instrument. So regarding the option valuation, one particular model has become very popular, that not very popular and also commonly used, that is the BSM model, which is known as Black-Scholes and Merton option pricing model. So if you would take the financial derivatives or the derivatives course, you will be very likely to spend a good amount of time to learn how to apply the BSM model to price and option, which includes the strike price, which includes the risk-free rate, which also assumes that kind of that we know that how volatility will look like during the holding period of the option. Okay, so these things are part of traditional finance, and these theories, these models are based on some common assumptions. So in behavioral finance, the assumptions are challenged. Which assumptions? The assumptions made by the traditional finance. Okay. So in behavioral finance, what we do, first of all, it rather than uh, basing basing or understanding individuals' behavior based on some assumptions, we based on some idealistic conditions, we try to understand how people actually behave in the market. And behavioral finance intends to understand how people uh, behave and what are the assumptions based on that behavior, and what kind of assumptions people do make in their real life to think of the or to make some certain decisions. Okay, so the assumptions what we do make in case of traditional finance are strongly challenged by the behavioral finance. And behavioral finance disregards the rationality assumption. And you probably have come to know about the efficiency of financial market, which is a most controversial discussed topic in the finance, that whether market is efficient or market is not efficient. Okay, so if market is efficient, in that case behavioral finance should not play a significant role. But behavioral finance theorists assume that market is not efficient. There is even they don't say that market is inefficient, rather there is a divergence of efficiency. You probably have learned about the weak form, semi-strong form, and a strong form of market efficiency. And behavioral finance discusses its contents in two parts. One is in with respect to individual behavior, like how an individual makes some makes some decisions which are behaviorally inclined rather than rational factors. Behavioral finance, this is behavioral finance micro. That means it deals with individual investor or individual person. But in aggregate, it is likely that all individuals or most of the individuals in a market can exhibit some common behavioral pattern. So, for example, if you look at our stock market nowadays, you would see that many people are trying to, many people have a very positive sentiment regarding the stock market. So they try to overestimate sometime the value of some securities which should not be. So in aggregate, that is happening. So in that case, the behavioral pattern of the all individuals or in aggregate the market is discussed in the behavioral finance macro. This is behavioral finance macro. And I gave a hint in previous slide regarding the cognitive errors. So behavioral biases are commonly classified into basket. One basket is titled as cognitive errors, and another basket is known as emotional biases. So cognitive errors, what do we understand by the cognitive errors? That is kind of the errors which come from some mistakes in the processing of information. For example, let's say, uh, let me give you an example of a bias so that you can understand what do you mean by it. Okay. One of the examples of cognitive errors is kind of hindsight bias. Okay, so
hindsight bias জানো এই যে hindsight bias নিয়ে আমাদের
yeah, you want to say something?
no sir sorry
Okay, uh, so for example, in some cases you have for example you have heard that or an investor is just has got a new information that the stock the stock will the stock has fallen by 10%. For example, an investor has got a new information that the stock has falls by 10% today. Okay, so it is likely that investor tries to convince other people or other analysts that I knew about it, that I had I was aware or I thought that it would happen. But it is after availability of the thing what happened. So, for example, there is a game between, say, Germany and Brazil. Okay, so let's assume that Germany has lost the game. So some Brazil supporters after the game will try to argue that we knew before the game that German would lose the game. So are you familiar with this kind of bias that people exhibit? After knowing this, people try to claim that they knew it before. Are you familiar with this?
Yes, sir.
So this kind of bias is a kind of hindsight bias. So this actually comes from the information processing, this kind of things and faulty thinking, and it should not be. Okay. So, and another bias, I like to give example to understand the cognitive error. Kind of, for example, let's say you are in a meeting. Okay. You are in a meeting. So the convener or the supervisor just has arrived, and that the purpose of the meeting is to discuss what will happen to the market, that how for example, let me give you an information fact, like for example, any one of you do not know that what is about the current inflation rate. What is about the current inflation rate? You do not have any facts and figure. Okay, you do not have any evidence. You do not have any information right now. Okay, but the supervisor who just has started the meeting has said that I think the inflation in this month should be 6%. Or not in this month, I mean the previous month. It is a historical data. Okay, but the data is not available to any one of this person who are present in the meeting. So the supervisor just has said that I think the inflation is 6%. Okay, so it is likely that the participants here and supervisor has asked from the participants, what do you think? What happened the inflation in the previous month? Do you have an idea? So it is very likely that participants will give or will try to tell some numbers which are very close to 6%. Which are very close to 6%. It may be like that the reality, the inflation is, for example, 8%, or the inflation is, for example, 4%, or inflation is 5.35%. But no one will try to say a number which significantly diverges from the number which has been presented at very initial point of time. Is it familiar with you, this kind of situation?
Yes, sir.
Okay. Now, let me give you another example. What kind of bias you are trying to understand right now? This is a kind of anchoring bias. This kind of anchoring that initial information has been given to you, and you want to come up with some numbers, or you want to come up with some facts which are very close to this. And if the real fact is much different from this, you are likely not to present this. Okay. So that is kind of the anchoring bias, which is related to the cognitive errors. Okay. So which are kind of come from faulty thinking. And it is possible that if you give training to the people, and if you try to advise the people, people will try to come out from this kind of error. Okay. Then another bias category, which is known as emotional bias. For example, I'm a Bangladeshi investor, and I belong to Chittagong. So I have told my portfolio manager that uh, include, okay, you have included these stocks to my portfolio. You have included these stocks to my portfolio, 1, 2, 3, 4. I'm just giving some numbers to say that these stocks are in my portfolio. Okay. But include Peninsula. Include Peninsula in my portfolio because Peninsula does business in my hometown. Okay. So is it likely that investors can request the asset manager to include this kind of stock which is not justified by the risk return profile? Is it likely?
Yes, sir.
So it is known as home bias. Okay. It is known as home bias. Okay. So if I give you two companies to pick out, one company is Mosaic, another company is say RK Ceramic. So many of you will try to pick this as you to you this word is new, or this company name is new, and this company does not operate in Bangladesh. So that's why you have picked this, though the fundamentals can be better for Mosaic company. Okay, but you are likely to pick this RK Ceramic because you are emotionally biased to this RK Ceramic. Why? Because this company is your home company. Okay, so it has been found that US investors are likely to invest in are more likely to invest in the US stocks or North American stocks compared to the Chinese stocks, though the fundamentals of Chinese stocks are good compared to the fundamental of US stock. Okay, so this kind of bias, your biasness to home, is a kind of emotional bias which comes from feelings, which comes from your attachment, these things. Okay, So why these two types of biases are different? The reason is that you can modify, you can help people to come out from this kind of bias, cognitive errors. Remember, though I have mentioned the bias, these things, but we need to understand this in terms of error. Though this kind of things exhibit some biases, but usually these things are error because error are error can be corrected. Error can be corrected by giving some training, by giving more information, more suggestion. But biases cannot be corrected. Biases cannot be corrected. Okay. So you need to recognize the difference between these two. So we need to understand, or many of the things we already have understood, that about the individual's behavior, how traditional finance look at the individual investor or individual behavior. Okay, so we have learned that rational investors always try to make decisions which are consistent with the utility theory and revise expectation that reflects the base formula. Okay, so things you need to recognize. One is individual people preference. Individual people preference should reflect the axioms of utility. Should reflect the axioms of utility. Can you recall the axioms of utility? We talked about it. Can anyone recall that we learned about the axioms of utility function?
Yes, sir. Four axioms of utility.
Yeah, based on which the utility function is built on. Okay, so those are some assumptions. I think we have spent a good amount of time to understand the examples of axioms, and so we do not like to discuss on that. But the thing is that when we talked about traditional finance, it assumes that individual preference reflects the utility theory. Utility theory it means that it reflects the axioms of utility. That means individual preference is very consistent with the axioms of utility. And individuals are likely to, not likely, individual should update. If he wants to be rational, he should update his knowledge, he should update his probability with the help of base formula. Can you recall the base formula we learned in applied statistics? Your favorite base formula?
Yes, sir.
Okay. So people will try to show an example so that you can recall what we learned in base formula. Okay. So people maximize their utility. So how people maximize their utility? So people want to maximize their probability weighted average of utility. So what does that mean? Say from a lottery, there is a probability of 30% that you will achieve 10 taka, 20% probability that you will achieve 5 taka, 50% probability that you will achieve only 1. Okay. So it is possible that when you have the utility function, convert this into utility term, that you have some utility function kind of this like this. Okay, not this. C, for example. Okay, C means consumption. we denote this also by this. Okay. Can anyone tell me what is the name of this Latin notation? I told you in class. Anyone? No one? Okay. Can anyone tell me the name of the Chinese president?
So Xi Jinping.
Okay. So she can be written in this way.
Yes, sir.
Okay. So this is the pronunciation of this term. Okay. This Latin term, you will try to spend time to understand this. We are familiar with only alpha, beta, then gamma, then lambda. Okay. But the thing is that there will be a handful number of Greek notations which are used in standard mathematical, finance, and economic text and research papers. So as you are comfortable with this, because you already have used this, okay? So when you will become comfortable using this, and you will know that what do we mean by this, in that case, it will be easier for you to understand the research papers and the academic papers written in this finance, economics, and mathematics field. Okay. So otherwise, we will not feel comfortable with this. Okay. So there are some apps from Play Store or App Store you can download to learn about the Greek symbols or Greek Latin. Okay. This Latin notation. So what is the purpose? The purpose already has been mentioned. So what is the purpose of using this? Say when I have mentioned that log, nature log of some consumption, should I write the consumption here? I should not write the consumption here. So when you have been able to write this term, which is used by the academia to explain or to mean the consumption or the payoff or the outcome or the expected return when the outcome is presented in terms of percentage, it saves you your time to say more words, and it saves you the space to write more words for it. Okay, so that is the purpose of using the notation. Okay, for example, just think of in mathematics we use the plus sign, so it has some meaning. It has some meaning. For example, if there was no existence of this, if there is no existence of this operator, the plus operator, we need to write in words that we need to spend a number of words to explain what we are going to do. But when we have just written the plus sign, what happened? It has become very easier for us. Okay. So what we are trying to say that when you will convert this outcome into some utility numbers using some utility function, it is a kind of one utility function, one example of utility function we showed in previous session. So what you like to do, for example, by converting this, you have got this to say 1.5, you have got this utility number, and don't forget the probability. So what is the purpose now? Your purpose is to now get the weighted average of the utility. So you have got the weighted average by multiplying the utility number by which number? Probability number, by some probability number. And you are very familiar with this kind of weighted average probability calculation from your math and statistics course. Okay, so people want to maximize this. People want to maximize this, which is known as the weighted average of their utility. Okay, uh, people put weight by their respective probabilities, but there is a thing that people can maximize the utility given the constraint of their budget. Though this utility derived from this indifference curve should be higher, but it is not achievable given the budget constraint. So that is the basic understanding of the assumptions in traditional finance. And one thing that is to be noted, that is usually people for the same product, for example, think of a plate of biryani. This plate of biryani has a particular price, say 200 taka. Say 200 taka. Okay. But think of two person. One person is rich, another person is poor. So you can recognize that though price is 200 taka, the value of this same plate of biryani is different to the rich person and to the poor person. And you can also compare this value a single person during different stages of life. Okay. So for example, when you are a second year student in the university, and when you are now corporate job holder, the utility from the utility from the khichuri available in the university will be different to you. So when you are second year student, the utility from that same plate of khichuri will be greater compared to the situation when you are a corporate job holder. So this utility determines the value the person recognize that this person has this amount of value. So this value stems not from the price it takes, rather this value what say rich person or the poor person gets the value, it's based on the utility. Okay, so this utility diverges, this utility differs from the situation to situation, and utility function of every individual is distinctive. Utility concept is not a universal concept. Utility is very much specific. Okay, so if you can't recall the axioms of the utility function, you need to recognize that we have already discussed how this axiom play. Okay. Then we already have mentioned that a rational person update his belief with the help of base formula when the new information comes in. Okay. So if the independent probability of an event is, say, probability of event without any information, and the question is how you accommodate this probability of event when the new information becomes available. Okay, so Bayes has given this concept and given this formulation that how you need to adjust this existing probability when the new information comes in. Okay, so can you recall this formula you are shown in when you are sophomore? Can you recall this kind of? Yeah.
Yes, sir.
Okay. Okay. So let me give you an example that you have two identical urns Are you familiar with this word, urns? Anyone? You're taking much time.
No, sir.
Okay. Have you seen this kind of jar?
Yes, sir.
Okay, these are known as urn. Okay, these are known as urn. So think of two urns. One is urn 1, another one urn is urn 2. Okay, so in one urn, there are two red ball in U1. U1 means urn 1. In urn 1, there are two red balls and three white balls. And urn 2, let me write down it first for you. Two red ball, three white ball. I just have written this. These are not 2R3W. Okay, I just have written this information. U2, that means urn 2 has four red balls, and how many white balls? One white ball. Okay. You randomly choose one of the urns to pick out a ball. So these two urns are very identical. So it is not possible to recognize that which urn you have picked. So for example, it has been said that you have randomly chosen one of the urns, okay, to pick out a ball. So the ball which has been picked by you, let's say that ball is a red ball. So the question is, what is the probability that you have picked the U1? That means the first urn, or the U1, given that the ball you have picked is the red ball. Have you got the question?
Yes, sir.
So in that case, how can we solve this kind of problem? We need to write that what is the independent probability of the event first when the no information is available. Then we need to multiply this. What is the probability of selecting the red ball given that urn 1 has been selected? It is the probability of information given the event, the opposite of this. Okay, and we have to divide this number by probability of the information, right? So let's try to look at the number. Out of the two urns, what is the probability that urn 1 has been selected?
So 50%.
Then if urn 1 is selected, what is the probability of getting the red ball? In the urn 1, how many balls are there? Two red
5.
ball, three white ball. So there are 5 balls. So the probability of selecting red ball out of 5 ball is this.
Yes, sir.
So can we write 0.4 here? Okay. Now what is the probability of selecting red ball only, irrespective of the urn? How many red balls are in total?
So 6.
There are 2, there are 4. So 6 red balls in total, and in 2 urns there are total 10 balls. So
Yes.
probability of getting a red ball out of the total 10 balls is 0.6. So your calculator will give you some number, or you can come up with some number.
So 1 by
That
3.
is the probability of what? That is the probability that you have selected earn 1, given that the ball was red ball or white ball.
So red ball.
The ball was red ball. Okay. So a person who complies with who has utility function which are complies with the axioms we mentioned, and who update his probability based on that, based on the using the base formula, and who try to achieve his optimal consumption in this way, where his utility curve has tangency with his budget constraint. A person who follows this, what I just have mentioned, that person is known as RAM, or rational economic man. Rational economic man. Okay. So what does rational economic man will do? A rational economic man will decide that, say, right now we have 54 participants. So the rational economic man will decide that there are two options right now available for me. One is attending the class of portfolio management online, and to spend time in social media. Okay. So out of the 556 participants who are currently attending the class, if some of them are rational economic men, he will try to decide that what will be the utility if I spend 10 minutes more in the class and 10 minutes or 10 minutes more in the social media. Okay, so he will try to draw a budget constraint. Here, budget constraint does not mean a financial amount. Budget constraint is the available time. Say we have class hours for 120 minutes. Okay, so how he tries to allocate this 120 minutes before between class and the social media, online class and the social media. Okay, so he'll try to decide that his say his indifference curve is like this. Okay, he's a kind of good student who tries to spend more time on the class, less time in social media. Okay, so he will try to make some calculus. Can you recall that you applied the differential calculus first order condition to get the tangency point? Can you recall?
Yes, sir.
Okay, to get the tangency point, you need to apply the first order condition. Okay, so the person will go to this point by solving some mathematical application, calculus, differential calculus, first order condition. Okay, but matter is that though his utility function may suggest that his utility will be maximum here, but it is observed that he is spending more time here. He's actually standing here rather than standing here. So what does it mean? Because he has some fear, he has some love, he has some pleasure, which cannot be expressed in terms of the utility, or which cannot be accommodated in the mathematical models to go to reach at this point. Okay. And another thing rational economic man does is that rational economic man collects all available information required to take a perfect decision. Okay. So for example, think of how you have chosen the University of Dhaka to give the admission test. Okay. So after having or before appearing in the HSC examination, you have more information about the University of Dhaka from your seniors that they have selected this for study. But after getting admission in this university, you are thinking that the information from other universities say you would have the opportunity to study in some foreign university. You would have some opportunity to study in a very good private university. But the information of this foreign university, the information about this best private university compared to this poor public university are not available with you. That's why you have decided to appear here, the admission test, and you have decided only this. Okay, so some of you have this kind of feeling what I just have mentioned. Okay, so if you ask what was the reason for that, because you didn't have the information. You didn't have the information required to evaluate all of this option. That's why when you are studying in this university right now, you feel that you are achieving or you are having or you are getting less utility from this university compared to the utility you would get from studying in this well-known foreign university or a very private university in this country. Okay, so the problem is that people do not have all the time the perfect or all information available, okay, on all which are essentially required to make a good decision. Okay, so that is the problem. So it's just for example. Don't think that I'm trying to underestimate some university. I'm just giving you an example. Okay, so we both belong to the same university. Okay, then risk aversion attitude, what is assumed by the traditional finance? Traditional finance assumes that, and from the very first class of the finance, you have learned that individuals are risk averse. Individuals are risk averse, and you have written this sentence, I think more than 100 times in your script, that individual investors are risk averse, individuals are generally risk averse, this thing. Okay. So who has thought these things? Finance has thought these things. Which finance? Traditional finance. So how traditional finance has got these things? Traditional finance has got these things from the utility concept, which has been introduced to you in previous session. You can recall that we have mentioned that individual get more utility. Individual get more utility from the expected wealth compared to the expected utility of wealth. Can you recall we have learned this? Individual get more utility from expected wealth compared to the expected utility of wealth. Can you recall a diagram we learned about to understand the risk aversion behavior, concave utility curve, then certainty equivalent, risk aversion, then the expected outcome from one gamble. One has higher outcome, another one has lower another outcome is low outcome. Can you recall that diagram? I'm
Yes,
not
sir.
opening that. Okay. From that diagram, you will see that we have concluded this. The individuals get more utility from expected wealth that is available to him or that is equal to that is kind of the probably that is kind of weighted average of the expected outcome. But that means the individual get more utility from the expected wealth compared to the expected utility of the wealth. Okay, so alternative individual get more utility from more certain thing compared to less certain thing. Okay, that is another concept. But when you exhibit or when you see this kind of attitude, you need to recognize that that person is risk lover or risk averse or risk neutral.
So risk averse.
Risk averse. And if these two are same, that person has no preference over either of this. He gets same utility from expected wealth, and his utility from expected utility from the wealth is also same. Okay, both are same. Utility from expected wealth and the expected utility from wealth, both are same. In that case, that person has risk
Neutral.
neutral attitude. And what would happen if that person get more utility from expected utility of wealth and compared to his utility from expected wealth?
Risk
That
lover.
person is gambler.
Yes, sir.
What's the characteristic of gambler?
So they love risk. They take more risk than average.
Okay. That person is risk lover, but don't go for writing the risk lover in your script.
So risk seeker. Risk
Risk
seeker.
seeker. Very good. Okay. So I told about the certainty equivalent to you, that individual get the same amount of utility. Can you recall the certainty equivalent? The amount of wealth from which individuals get the same utility which is available from the expected wealth of a uncertain outcome, of two uncertain outcome. Okay, so the amount of wealth which is obviously which is the certainty equivalent wealth is always lower than the expected wealth from a gamble or from a risky outcome. Okay, but why certainty equivalent is important? Certainty equivalent is important because certainty equivalent from the utility perspective, investor gets or individual gets same amount of utility from the less amount of wealth. So that amount of wealth is certainty equivalent wealth. Okay. So the thing is that has anyone seen the game the game show I suggested to watch on YouTube? Had I suggested any show to watch to understand the certainty equivalent?
So I cannot remember. Sir.
Cannot remember. Anyone can remember?
No, sir.
No? Are you a member of Google Classroom?
Yes, sir.
Okay, but I probably have shared, mentioned about one game show based on which you can understand or you can get the concept of certainty equivalent very well. Can anyone recall the name of the game show? Though I recognize that you have not watched that, but can anyone recall that game show? I don't know what you watch all the time on YouTube, but I try to suggest you a show that is interesting. And you get more excitement when you see some interesting show, kind of which are like a game show.
Yes, sir.
Okay, but you didn't feel it much important to watch that show. So I'm not mentioning that show name right now because I want you to scroll the previous post, and you will see that I suggested you to watch a show, which will give you a good idea that what do we mean by the certainty equivalent. That gives the participant in the game show the same utility, uh, same of the utility what he is expecting to get from the upcoming or remaining uncertain outcome. So the host of the game show offers this amount of money to him, and the participant decides, and participants compare whether this amount of money which is offered to me and the outcome which is expected to be achieved by me if I play the game or if I continue to play the game, which one is better for me. So if the participant feels that the utility from this certain amount is greater for me, or utility from this amount is more to me, in that case, I will stop playing and I will take this money and go to home. I will not continue this. I will not continue playing this show. Otherwise, the person or the participant feels that instead of taking this amount, I will continue playing this show so that I will get more utility from the uncertain outcome, compared to the outcome which is available from this certain amount which is offered by the game host. Okay, so the risk attitude of individual investors are exhibited by the utility curve. So utility curve are like this. When we are saying utility curve can be presented in two ways. Say in previous, I already have showed two types. Okay. Say this is also an utility curve, though we are representing it mentioned is at indifference curve. It reflects the utility from two products simultaneously, or two outcome, or two types of consumption simultaneously. Okay, it is also an utility curve, but we know it by the indifference curve. Okay, so you can recognize that when the indifference curve go the right east or right west, if it is the direction,
Sir, right north.
right north,
Or sir, northeast.
northeast. In that case, we get more utility or less utility?
So more utility.
We get more utility. Okay, so you can recall that we showed this type of utility curve when we talked about the risk averse investor. You will see their utility curve is concave shaped. Here we are representing the utility not from two outcome or from two consumption, rather one outcome. One outcome is wealth, and the utility to be derived from that amount of wealth from different amount of wealth. Okay, so when the utility is diminishing marginal utility, which is the assumption of traditional finance, you see that the utility curve becomes concave or convex. It is concave or convex?
So concave.
Concave, and the opposite thing happens for the risk seeker. Okay, that is this. And if the person is risk neutral, what will happen to his utility curve? His utility curve will remain linearly constant, will remain linear, and his changes in utility from changes in wealth will remain constant. Okay, so we just have reviewed what traditional finance says about individual investor behavior. We just challenge those concepts what we just have reviewed with the how behavioral finance has challenges the concepts of traditional finance. Okay, so we learned that the individual does not have uh, all required information. That is one issue. Another issue is that though all information are available with the individual person, it may not be possible to get the perfect decision because individuals are prone to cognitive error, prone to exhibit some emotional biases. Okay, so because of that limitation coming from knowledge, coming from the cognitive capacity, individuals do not make rational decision always. Okay, and people have difficulty to to make the trade-off between the short term and the long term. Okay, now let's compare things. Say, um, if you think of the utility function of any average individual, his utility is likely to be higher if he thinks about the long term. If he thinks more about the long term, because the returns will be greater and more return will be accumulated if he can compromise his current leisure, current consumption, and current well-being. Okay, so every individual in our country, in our family, has a tendency to think from the long-term perspective, that how well or how happy I will be in the long term. So to become happy, more happy in long term, people have a tendency to save more nowadays, to consume less nowadays, and to have less leisure nowadays, to uh, to have more overtime in the younger age, right? Okay, but at the same time, you see that people enjoy leisure, people play golf, which requires a good amount of money. People go to some places, uh, some places close to nature to spend their leisure. But for what reason? If they are long-term oriented, they are not always long-term oriented, because sometimes they want to maximize their pleasure by spending leisure. So it is not always obviously clear that how individuals prioritize their short-term and the short-term compared to the long-term goal. Okay, so sometimes you see that people spend more. People spend more in younger age. He or she tries to think less about his or her long-term well-being. So that is the real thing which does not comply with the traditional finance. Okay. Then what about the utility maximization challenges to the utility maximization concept by the uh, behavioral finance? So you spent good amount of time to understand the indifference curve in the microeconomics, okay? And you are now applying the indifference curve, okay? So if it is likely that you have a kind of, say, what I have I already have given one example, that you have a class and you have another option to spend time in social media, okay? So you have 2 hours remaining. So, sorry. So indifference curve tells you that you will have the same utility on the indifference curve regardless of the point where you are staying. Okay. Pardon me for my poor drawing. Okay. So you see, the person can allocate 120 minutes like this. Say that person has done 80 minutes class and 40 minutes in social media, and that person say that person has 30 minutes in class and 90 minutes in social media. Okay. See, that person will have the same utility. But just think of if I have the technology to trace out, or if I use the attendance, that whether you are attending in the class or you are not physically present on the other side of my class. Okay. If I take the technology to assess that, okay, and I discard, for example, I have found this person who is spending 90 minutes in social media and only 30 minutes in class. Okay. What will happen to this person? I will delete all of his attendance. I will delete all of his attendance and I will give him some penalty. And it is likely that that person, that student will not be able to appear in the exam. What will happen to them? It will be an undesirable circumstance. So there's a risk that when you are moving from here to here, there is a risk. What kind of risk I just have mentioned? The risk that you will be dropped out from the year, or you'll be dropped out from the semester, or you'll be dropped out from the class. But the thing is that indifference curve has not given you the technology to accommodate this risk, which may happen in this option. Have you got this? Indifference curve has given you any suggestion what will happen, or has told you any technology that you can accommodate this risk by customizing this indifference curve? Is there any way?
So indifference ক্যারেক্টার শুধু আরেকটু যদি বেন্ড হইতো তাহলে কি দেখানো যেত?
Okay, you will try yourself and you will try to get some plausible explanation, and you will share that with me by sending email or by posting in the classroom. Okay, so that we can participate.
Okay, sure.
Okay, then we already have mentioned that traditional finance assumes that individuals have a concave utility curve which reflects the risk aversion attitude of investor or risk aversion attitude of individuals. Okay. But it has been found that an individual does not have the concave utility curve all the time, regardless of his wealth. So we have assumed in traditional finance in this way, that he has a risk aversion and concave utility shape. Okay. But it has been found that in reality, or a researcher has claimed that individual utility does not remain same across the level of wealth. His utility curve changes, which depends on his level of wealth, or the amount of wealth he or she is currently possessing. So he has suggested the utility of individual is look like this. Okay. There will be two inflection point. You're familiar with the inflection point term? Inflection point?
No, sir.
No? From your business calculus, you need to, you might have heard about this concept when the curvature changes. Okay. You see how many changes are here? One changes is here, another changes is here. So there are two inflection points. So you see the individual person when he was poor, or in this very low wealth region, that person was risk averse. And when the person is, should be like this, okay. That person is Does it look like risk averse or risk seeker? This one?
Risk seeker.
This person is risk seeker in this wealth region. And this person again becomes risk averse when his wealth level goes beyond this wealth level. Okay. So what does it mean? Just to give you an example, it has been found that middle class people, not the poor class, not the rich class people. Okay. Middle class people are very likely to buy the lottery ticket. This is the expected outcome of lottery. What is the expected outcome of lottery? Zero? How many of you in this class has a fortune that he has achieved 25 lakhs or 40 lakhs in a lottery? Anyone? Okay, let me give you another example. Price bond. Is there anyone who has
Yes, sir.
you? Okay, how many price bonds you possess?
Sir, around 50.
Around 50. And
Yes,
you
sir.
have own price bond in your life. Yeah?
Yes, sir.
Okay, is there anyone, a lucky person like Shagor?
Sir, I haven't won even a single time. So I am not lucky, sir.
Okay. The thing is that the outcome of the lottery prize bond is close to zero, very close to zero. And it has been found that just think of middle class people are very likely to buy the lottery ticket, to buy the prize bond. The rich people are not like, I'm not saying they're very unlikely, but unlikely to have the lottery ticket, and very poor people are not likely to have a lottery ticket or prize bond. But the middle class people, to them, the prize bond and the lottery ticket are favorite game or favorite investment options, okay, of which expected outcome is very close to zero, okay. So you can think of how risky it is that you are losing you are losing 100% of your investment, that you are not getting your 10 taka back anymore in your life, okay. But still knowing this, that you have a 0% probability that you will get at least 1000 taka from this 10 taka lottery, people don't stop by the lottery ticket, okay. So that is the risk seeking tendency of the people, and it has been found that middle class or the people in between poor and the rich are very likely to buy the lottery ticket, okay. So you may argue that it is not applicable. I'm a rich person, but I fond of buying the lottery ticket. You can argue that it is not guaranteed that you have to accept these research findings, okay. So there is the attitude toward risk, but related to this, the utility function, what I just have shown you, the modification of utility function has been suggested by the Daniel Kahneman and Amos Tversky in 1979. This is one of the paper. You will find it very interesting to read out if you really uh, feels very interesting to know about the behavioral finance and to know about statistics. This paper, Prospect Theory and Analysis of Decision Under Risk. So this paper was published in the Econometrica journal, which is very highly respected journal in the economics and in the social science, very specifically. So it was published in 1979, but this paper has citation more than 60,000. So you are very familiar with what we do mean by the citation, that the 60,000 papers have cited this paper for their own research. Okay, so you can understand how important or how contributing or how influencing this paper was, and how influencing this paper is still now to shape the behavioral finance. Okay, so matter is that this paper suggested a theory, a prospect theory, that tries to modify the utility function with which we are very familiar with. So rather than giving utility function or utility concepts, what we usually try to use, this prospect theory suggests some function which is known as value function instead of the utility function. So it has given two functions. One is the value function, and another is the probability function, probability weighted function. So before explaining these things, just recognize that what is the main concept of this prospect theory. Prospect theory says that individual analyze the prospect of all outcome. So for a decision, there will be several types of outcome. Okay, so individual tries to think of the prospects of each and every outcome that can arise from taking a decision. So that outcome prospect can be some gain, some outcome can be loss. But people have a tendency to look at the gains and losses differently. I'll tell you how. People have a tendency to look at the same amount of gain and same amount of loss differently. And people considers and people analyze their outcome not in terms of the absolute outcome, but they try to think of what will happen to my final wealth when the outcome will be added. So instead of, for example, instead of having a 10 taka outcome and analyze it separately, let's think of I have a 100 taka amount of wealth. I'll try to think of what will happen to my final wealth when this 10 taka is added. So I will try to think from the perspective of 110, not from the 10. Okay, so 100 is coming from my existing wealth. So individuals are likely to use a reference point to think of their outcome and give value to those outcome. Okay, so what you are familiar with the concept of value. So value is a kind of subjective judgment, is a kind of subjective. It's not more like the utility function, but it can be compared to the utility function. Okay, so it's a kind of that how people generates value from a certain outcome. So how people believes that this will give me this amount of value, this will give me this amount of value. So it looks like utility, but this is different from utility because the subjectivity involved in the value. Okay. So people have a tendency to look at the gain and losses differently. And it has been mentioned that people are more sensitive to the losses compared to the gain. Okay, here we are representing the value function here, and we are representing the outcome with respect to wealth. Okay, it has been mentioned that individuals utility or value, here we are mentioning value function. Value function looks like concave in the gain horizon. Think of this is the gain horizon, this is the loss horizon. Okay, in the gain horizon, individual has a concave shape value function, and individual has convex shape value function in the loss horizon. Now, can anyone tell me between this utility, one is concave, this one is concave, this one is convex. Okay, which one has a higher slope or steepness is higher? Which one? In the loss horizon utility curve or in the gain curve?
The loss horizon.
This utility has or this value this in this portion value function has a higher steepness. Okay, so it means that people feel more strongly when they have similar amount of loss compared to similar amount of gain. So say there a person has a 5 million gain or a person has 5 million loss. So the amount of value also, just for simplicity, you are thinking of the happiness, the amount of happiness people get when they have been able to increase their wealth from, say, from here to here by 5 million, their happiness or their values go up at a small degree compared to if he loses the same amount of 5 million here. If he loses 5 million, you see, the loss of utility is higher here or the gain is higher here. The gain of utility from the 5 million win and the loss of utility from 5 million loss, which one has a higher sensitivity? In which case, investor feels very strongly here or here?
So in the loss portion.
Though the amount is same, if the amount are same, what would be expected? It was expected that for the same amount of gain and the same amount of loss, individual should behave the same way. An individual should, if individual feel this amount of happiness for having this 5 million gain, it is rational that individual should have same amount of unhappiness for having this amount of 5 million loss, same amount of loss. But it has been found just the opposite. Not the opposite, I mean the things are different. When it is in the loss horizon, for the same amount of loss, individual feels very strongly, very exaggeratedly about the small loss. Okay, have you got it?
Yes, sir.
So another thing which has been found by the prospect theory or concluded by the prospect theory, that is people want to take insurance, people want to have a very risky decisions when they are in the loss horizon. Okay. And another thing which is suggested by the prospect theory, that is probability weighted function, which is related to the probability we assign for the utility. Can you recall we assigned probability for different utility from the outcome?
Yes, sir.
Okay. So compare the probability weighted function with this probability we assign in traditional finance, but this is different here. Why this is different? This is different because individual assigns subjective probability here. So more subjective. And in addition to that, individual has a tendency to assign higher probability when the actual probability is low, and individual has tendency to assign lower probability when the actual probability is high. Okay, let me give you an example. So it is the actual probability, just assume that. But in the low horizon of the probability, here it starts from 0, it finishes at 1. Probability should range from 0 to 1. So it has been found that in the low horizon of the probability, individuals are likely to assign more probability, and when the probability is actually higher, individual assigns low probability. It is the high region and it is the low region. So this is the probability, the curvature curve line indicates the probability assigned by the individuals in common. Okay. So say, think of this point. Can anyone tell me your rough estimate of the probability of plane crash? The plane is to be crashed. What is the probability?
So below 1%.
Below 1%. Okay, let me write it for 1% here. Okay. So you have mentioned the 1% based on some objective number, based on some objective estimation, because you are familiar, or you have some news that how likely or how many plane crash news you have seen in your life, right? Okay. But it's very likely that people put more probability that plane crash will happen. Is it likely? Is it likely?
Sir, আপনার কথা শুনতে পারিনি।
I mean, though the probability is actually lower for being a plane is to be crashed, right? Okay. But people have a tendency to think that plane crash is more likely.
Yes, sir.
Okay. So there's a insurance which is known as charter insurance. Have you heard about it? Huh?
No, sir.
Okay, you have not heard about it because it is not available in our country. Okay, so in our country, many insurance products are not available. But just to recognize that in developed country, before boarding on the flight, the flight operator sells some insurance on a spot. The insurance is known as charter insurance. So it will compensate you if the charter faces accident or your plane crashed. Your plane gets crashed. Okay. So if your plane gets crashed, if you really feel that, if you really know that, or if individuals know that the probability of plane crash is very low. Okay, if it is true, why people buy charter insurance?
So
Why people buy charter insurance? Because people feel that people feeling of the probability is higher than the objective probability, okay, or the actual probability. Okay, you can think of another example here. For time constant, I'm not giving example here. I'm just closing our session just by telling something about the neuroeconomics that is part of behavioral finance. But in addition to behavioral finance, it includes the neuroscience, it includes the psychology, and it includes the economics to understand how investor, how individuals, how market behave, and to explain or to expect that how individuals are likely to behave if this thing happen. Okay. So another thing that is important to know that this neuroeconomics uses imaging of brain activity. Okay. So I think you probably have seen that how brain looks like, right?
Yes,
You
sir.
probably have seen the how brain looks like. So there are so many chemicals in the brain which can be studied to understand that why this person, for example, person A is doing this behavior, why person A is risk taker, why person B is risk neutral. It is possible to analyze the brain image to understand the people behavior related with the asset manager. Okay, in asset management industry, it has been started that asset managers attitude, asset manager preference, asset managers risk-taking tendency will be examined by taking the image of their brain. Okay, so it is not always case that you will have only technical skills and soft skills. If it is likely that your brain image shows that you will be more likely to be a risk seeker, but the asset manager, the recruiter is looking for some risk neutral. Okay, just for example, in that case, it is likely that you will not be taken. Okay, so some chemical examples are dopamine, serotonin. You probably have heard about the dopamine, right? Okay. So just to give you an example that you see that some people are very risk take are in a nature of taking more and more risk, though they know that if we take more risk, our position will be riskier. But though you are suggesting him not to take more risks, not to take higher risks, but he is very likely to take higher risk. He is trying to say he is trying to invest in a startup. He is trying to initiate 5 more startup. You see this kind of people in your class or in your senior from your seniors that instead of going to the say public sector or the private sector, they are trying to open up some startups. And
Yes, sir.
they have devoted their life and they have compromised their sleepings, their happiness to build up this startup. See this kind of people. So what is the reason? The reason is that this kind of people, if you understand their brain image, you will see their dopamine gets released. Their dopamine get released more when they take more risk, when they take higher risk, right? So this is one example. Another example is uh, amygdala. That is, you'll see this kind of chemical plays role when investor or people are in fear condition. Okay, in fear condition, you will see that it is very unlikely that you will make a good decision or you will make a correct decision. Okay, say market has crashed in 2011. Okay, market is crashed in 2011 or during this time 2010 to 2011. So it is riskier for the margin investors to carry out their position because their leverage will cause higher burden for them. But many people who didn't have the margin, they have their own investment only, and you would see that many of them had their position in a good price. I mean, their buy price was good. Their buy price was not very high. But looking at the aggregate market fall, they have sold out their position. They didn't think that if I wait till 2015, I will be able to get back to my position. I will be able to come out from the market with a very good price or very reasonable price. But instead of thinking about this, looking at the fear across the market, they have sold out their position. So this chemical in the brain plays role in the emotion in such a case when there is a anxiety, there is a fear, and people have two options, either fight or flight. Okay, so that is all about for today's session. So I would like to request you to read out the section 3 by yourself in the vacation, and we will talk about we will start from the section 4 from the next session.